Welcome to Steadyhand's 2021 Mid-Year Review. I'm Tom Bradley, Chair and Co-Chief Investment Officer. We're going to spend the next 10 minutes bringing you up to speed on what's proved to be another really interesting year. We'll look at why things have been so good, and talk about what we've been doing in your portfolio. Before we do that, however, we're going to start by providing some perspective on a topic that's impacting all of us, and many of you are thinking about a lot, and that's inflation. Now, in our writing and communication, we often warn our clients to not get too focused on just one issue or topic when making investment decisions. As much as elections or government debt levels or trade wars are important, bond and stock prices are driven by a myriad of factors, some that are right in front and center on your news feed, and others that are hidden in the shadows. And quite often, as I talk about, those shadow issues can be really important. But inflation, it's right in the spotlight, and it is important. It is going to help determine the magnitude of returns going forward and the shape that they take. So at this point, I'm going to turn it over to my co-CIO, Salman Ahmed, to talk about inflation and how it integrates with your portfolio. Salman?
Thanks, Tom. Now, as Tom mentioned, inflation is increasingly becoming a topic of discussion, and you can see why here. Inflation has spiked over the last couple of months in 2021, and these are some of the highest inflation readings we've seen in quite some time, and they're well above what our central bank targets. But that central bank has also been trying to raise inflation to get us out of a period of low inflation and even deflation, which is when prices fall. So this all seems pretty unclear. And even among economists, there is no consensus. You'll find some economists are warning about high inflation, some deflation, and pretty much everything in between. So how should investors deal with this lack of clarity over future prices? Well, investors have to deal with uncertainty all the time. Uncertainty over economic growth, over elections, regulations, and so on. And really, there's only one way to deal with this constant state of uncertainty, and that's to have balance. Balance in your portfolios is what gets us through the unknowns. And that's exactly what our two balance funds are meant to do for you. Now, for this update, I'm going to focus on just one of them, the Founders Fund, because it has a longer history and it's a good representation of our average client's experience. So far in 2021 and over the last 12 months, the fund has produced returns that rank above peers in the market. Since its launch more than 9 years ago, the fund has returned more than 7% per year on average after fees. Now keep in mind, that period includes an unprecedented pandemic, multiple election cycles, a European debt crisis, evolving regulations, and lots else that we're trying to put behind us. So what I'm trying to say is balance works, and it's what's going to get us through this period of inflationary ambiguity as well. And that's what I'm going to cover over the next couple of minutes. We'll go through the ways your portfolio is diversified. We'll look first at stocks, then we'll talk a little bit about fixed income, and my comments will continue to focus on the Founders Fund. Now, the fund has multiple layers of diversification built into it. It's invested across many regions and regions with differing economic climates and inflationary environments. For example, Europe and Japan have not seen the same level of inflation that we've experienced here at home, and even what our neighbors to the south have experienced. The fund is also invested in companies from a variety of industries, and you can see that here. And each of these companies experiences inflation differently. And I'll use a couple of examples to illustrate my point. One of our holdings, AZEK, which is a recent addition, is among the leaders in composite decking. The composite decks last longer and have consistently been taking market share away from wooden decks. But over the last year, AZEK has seen this huge surge in demand because inflation in lumber prices has pushed homeowners to look at composite decking as an affordable alternative. So it's been a boon for AZEK. By contrast, price increases in lumber or even other materials don't affect one of our other major holdings, which is Microsoft. Now, its prospects are driven by businesses digitizing and moving to the cloud. But where the company may feel inflation is with its biggest cost item, which is people. If wage inflation takes hold, Microsoft has to pay employees more. But fortunately for shareholders, this is a tech powerhouse, and it's got the pricing power to offset any of those cost increases. So two very different companies which are impacted by inflation differently. Well, what about fixed income? 40% of the Founders Fund is comprised of bonds and cash, and neither of them like inflation. Cash doesn't grow, so it buys you less as prices increase around you. But if there's deflation, cash doesn't seem like such a bad idea. Now for bonds, higher inflation means higher interest rates. And as rates rise, bond prices fall. But again, in a period of low or even falling inflation, bonds can do well as they have over the last decade. And of course, inflation isn't the only thing to consider. Fixed income provides you protection when stocks fall, as they did in March and April of last year. Fixed income is less volatile. So I want to leave you with 3 points that you should consider as you think about inflation in your portfolio. First, how a company is impacted by inflation varies very much by what the source of that inflation is. We saw with AZEK, inflation in lumber prices improved its competitive position. Second, we're buying investments that we believe will do well whether prices rise or fall. Now, Microsoft and AZEK have a very strong investment case behind them despite what might happen with inflation. And last, we're building portfolios that can stand up to a variety of opportunities and risks, not just inflation. Inflation is for sure the topic of today, but there's lots of other issues like trade. There's a rapidly expanding middle class in emerging economies. And of course, valuations, or how much investors are willing to pay today for the potential of future profits. And this last one is one of the best predictors of future return. So your portfolio is impacted by many things. Inflation is just one of them. And I think that's a good place to bring Tom back. He'll highlight what we've been doing in the Founders Fund as we consider some of these opportunities and risks in aggregate. Tom?
Well, Salman, you and I have talked about this a lot, and we don't think it's a time to stick your neck out right now. We're heading into a spurt of economic growth as the economy opens up, but in general, the potential rewards for taking risk right now are not high. Let me explain what I mean. In the bond market, the extra yield you receive from holding a riskier bond right now is quite modest. The spread, as we call it, which is the yield over and above the Government of Canada bond yield, is near historic lows. So when you take risk by owning either a provincial bond or a corporate bond, or what's not on this chart, a riskier high yield bond, there's just not enough extra yield to justify the risk, at least in many cases. Now, if we go to the stock side, companies that have benefited from COVID lockdown have continued to trade at rich valuations, and the companies that have really benefited the portfolio in the last year, recovery stocks as they're called, have really got to the point where they're discounting a pretty full recovery. And you can see from this valuation chart of the overall market, it coincides very much from what we're hearing from our managers, that they're having a tough time finding undervalued securities. Now, despite the uncertainty around the reopening, around inflation, investors remain very optimistic, and dare I say, some of them are even prone to speculation. We have a period right now, and you can see it in the volatility in Bitcoin, in the meme stocks, where risk-taking is very prevalent. And what worries us is that there's some complacency around risk right now. Now, if our neck isn't being stuck out, what are we doing? Well, I'm going to use the Founders Fund like Salman did to explain. And as he said, we have been gradually trimming back the stocks in the Founders Fund to where we're now at the 60% long-term target. And you'll see by reading the quarterly report that our managers have been using any market volatility that comes along to trim stocks, to add, to eliminate something, or even bring in a new name. And the bottom right of this chart, those 4 equity managers, we think that all have 4 different mandates, provide us with excellent diversification across industries, geographies, currencies, and as we've talked about today, market themes like inflation or opening up versus locking down. Now, to stick with that analogy about sticking your neck out, what should you do? And the answer is we think you should stay close to home. Stick to your plan, contribute as regularly as you can, just as you've been doing already. Keep your borrowing under control, as tempting as those low interest rates are. And if you need money for an upcoming trip or a project, set it aside now and put it in cash. And most importantly, we want all our clients to enjoy our great Canadian summer. So thank you for watching and for your continued confidence in Steadyhand.